Welcome to my trading journey, learning step by step, a 10-part series designed for anyone who's curious about trading but feels overwhelmed by all the technical jargon. This is the very first episode, and throughout the series, we'll explore foundational ideas, practical tools, and common mistakes, all from the perspective of someone who's learning, not teaching. The narrator isn't a financial expert, just someone who learns day by day, diving into research and applying knowledge through real-life experiences. If you've ever felt lost when it comes to managing money, analyzing charts, or just figuring out where to start, you're not alone. This journey is for people like us, and every step forward counts. Why would anyone want to learn trading in the first place? The short answer: because money affects almost every part of our lives, and trading offers a way to take more control over it. But here's the honest truth: trading isn't a guaranteed path to wealth. It's not a get-rich-quick scheme. In fact, for many, it can be confusing, stressful, and full of setbacks. So why do people keep diving in? Let's explore some real and grounded reasons. Section 1. To better understand money and markets. Beyond the charts, trading as a social science. Learning about trading goes far beyond analyzing candles or calculating indicators. It's an immersion into the invisible forces that drive the world: capital flows, collective behavior, and the relationship between information and value. Mastering these concepts not only helps you trade better, but also gives you a unique lens to understand how money shapes societies, politics, and even personal decisions. 1. Supply and demand, the universal language of markets. What it means: prices go up when demand exceeds supply, and down when the opposite happens. Macro example: the semiconductor crisis, 2021-2023, led to a 300% price surge in chips, affecting everything from cars to smartphones. Micro example: a flash sale on an e-commerce site creates artificial demand, clearing out stock in hours. Why it matters: personal decisions, understanding supply and demand can help you negotiate better salaries. Is your skill rare? Raise your value. Choose solid investments, like gold during crises, or avoid real estate bubbles. Price is the message the market sends about the balance between scarcity and desire. Adapted from Milton Friedman. 2. News and global events, the financial butterfly effect. How it works: chain reactions. A truck driver strike in Brazil disrupts soy exports, raises global prices, spikes inflation in China, reduces pork consumption. Interconnected markets. The war in Ukraine, 2022, pushed prices of wheat, fertilizers, and natural gas sky high, affecting bakeries in Europe and farms in Brazil. Practical use. Risk anticipation. Knowing U.S. job reports, NFP, trigger volatility, helps avoid investing right before the data release. Budgeting. If the dollar rises due to U.S. interest rates, imported goods like electronics or medication become more expensive in your country. 3. Daily decisions with a trader's mindset. Smart consumption. Trend analysis. Buying flight tickets on low-demand days, like Tuesdays, can save up to 40%. Avoiding FOMO. Resist impulsive Black Friday purchases. Ask yourself, do I really need this, or am I reacting to artificial urgency? B. Personal investments. Resource allocation. Treat your time and money like a portfolio. Low risk. A vocational course in high-demand fields, for example nursing. High risk. Starting a business in an emerging area, for example, artificial intelligence. C. Critical news reading. Beyond the headline. When the central bank cuts interest rates, ask, how does this affect your fixed income investments? Could it stimulate the housing credit market? Conclusion: trading as a tool for financial autonomy. Mastering trading principles isn't about getting rich quick, it's about gaining economic literacy. In a world where climate change, AI, and geopolitical crises constantly redefine value, this knowledge becomes a survival tool. Next steps. 1. Study economic cycles, for example Ray Dalio's principles for navigating big debt crises. 2. Practice cause and effect analysis while reading the news, for example, what's the real impact of Middle East conflicts on oil prices? 3. Apply strategic thinking to your personal finances, for example diversify income like a portfolio. Money is a social force. To understand it is to understand how power moves, and how you can move with it. Section 2. To build financial discipline. Trading is often reduced to a technical activity: charts, indicators, and patterns. However, its deeper essence lies in the reprogramming of habits and the development of emotional maturity. It works like a mirror that reflects primitive human impulses, like greed and fear, and transforms them into opportunities for growth. This topic explores how the practice of trading teaches transferable skills for all areas of life. From personal finances to professional relationships. 1. Confronting impulsive habits, the root of mistakes. What are impulsive habits? Definition: automatic and unreflective behaviors, such as buying due to FOMO, fear of missing out, or panic selling after a temporary drop. Example in trading: a trader enters a Bitcoin position because everyone is making money, ignoring their original strategy. How trading exposes these habits. Instant feedback: fast losses reveal self-sabotaging patterns. For example, investing $1,000 without analysis after reading a social media post. Repetition cycle: without discipline, the trader repeats mistakes, like overtrading after a streak of wins. Practical solution: create a pre-trade checklist. For example, 1. Is the asset aligned with my strategy? 2. Am I risking no more than 2% of my capital? 3. Are there any major upcoming news events, for example, U.S. job report? 2. Risk management: the art of protecting what matters. Core principles: proper position sizing: never risk more than you can afford to lose. For example, limit each trade to 1% of total capital. Stop loss as an ally: set an automatic exit point. For example, sell a stock if it drops 5% below entry price. Application beyond trading. Personal finances: having an emergency fund equal to 6 months of expenses is a stop loss against unexpected situations. Career: diversify your professional skills to reduce dependence on a single job. Real case: a trader who lost $5,000 by ignoring a stop loss learned to apply the same principle in his spending. Now he avoids impulse purchases by setting a maximum budget for each category. 3. Emotional control: taming the survival instinct. Key emotions and their effects. Fear leads to paralysis or premature exits. For example, selling Apple stock during a dip, missing a 20% rebound. Greed encourages holding winning positions beyond reason. For example, holding a soaring cryptocurrency until a 50% drop erases the profits. Emotional regulation techniques. Tactical breathing: before clicking buy, inhale for 4 seconds, hold for 7, exhale for 8, for 7-8 method. Emotional journaling: write entries like, I felt anxious today because the market was volatile, to identify emotional triggers. 4. Strategic thinking: the virtue of active patience. What it is. Definition: the ability to act only when conditions align with your plan, even if that means waiting days or weeks. Example in trading: a trader waits for a historic resistance breakout in gold before entering, ignoring smaller fluctuations. Result: fewer trades, but the accuracy rate increases from 40% to 65%. Application in daily life. Personal investments: wait for seasonal price drops to buy real estate or electronics. Career decisions: turn down a short-term job offer to wait for an opportunity aligned with long-term goals. Conclusion: trading as a metaphor for a balanced life. Trading is not just about financial operations, it's intensive self-management training. Every decision reflects your ability to balance reason and emotion, action and pause, ambition and humility. To take with you: 1. Monitor one impulsive habit per week. For example, checking your phone every 10 minutes. 2. Practice the 2% rule. In risky decisions, never commit more than 2% of your resources to a single choice. 3. Reward patience. Celebrate every time you wait for the right moment, whether in a negotiation or personal life. The greatest profit in trading isn't in the money, but in the freedom of someone who has learned to govern themselves. If you found this video valuable, don't forget to like, share, and leave your thoughts in the comments below. What part of today's episode made you think differently? And remember, I'm not a financial advisor. I'm learning like you, step by step, through life and research. Section 3. To open new opportunities. The rise of digital platforms and the globalization of markets have turned trading into an accessible skill. Today, it's no longer exclusive to Wall Street professionals. It's a flexible tool that can be adapted to individual goals. For some, it becomes a source of extra income. For others, a way to enhance long-term investments. Regardless of its use, its greatest value lies in the freedom of choice it offers, an antidote to financial passivity. This section explores how learning to trade goes beyond cryptocurrencies and becomes a foundation for conscious economic decisions across multiple areas of life. 1. Trading as a side activity, beyond the side hustle. What defines a parallel trader? Typical profile: professionals from other fields, doctors, teachers, designers, who dedicate 1-2 hours a day to structured trades. Common goal: generate extra income, for example $500 to $1,000 month, or diversify income streams. Strategic advantages, development of transferable skills. Risk analysis, evaluating trades teaches how to assess cost-benefit in everyday decisions, for example, buying a used car. Time management, prioritizing high-impact setups, for example, trading only during New York Stock Exchange opening, boost productivity. Geographic flexibility, mobile platforms allow trading from anywhere, fitting into various routines. Real-life example, Kelly, a civil engineer, uses her lunch break to trade S&P 500 mini contracts. In 6 months, she earned $1,200 net, funds she uses for professional development courses in her main field. Risk to mitigate, avoid the trap of emotional trading while juggling another job. Solution, use automated orders, take profit, stop loss, to protect capital without constant monitoring. 2. Trading as a foundation for long-term investing. Synergy between trading and investing. Hybrid strategy, use day trading techniques to build capital and reinvest profits in long-term assets. For example, ETFs, real estate. Practical example, a trader earns $5,000 annually from swing trading stocks and allocates 70% of it to a global ETF like VWR. In 10 years, with a 7% annual compounded return, this portion would grow to approximately equal $12,300. Strengthening discipline, macro perspective, trading on shorter timeframes, minutes, days, trains patience to wait years for traditional investment returns. Emotional control, daily exposure to volatility reduces fear of short-term drops in a buy and hold portfolio. Relevant data. A 2023 Fidelity study shows investors with trading experience are 34% more likely to hold positions during market crises compared to beginners. 3. Trading basics, a revolution in personal financial education. Universal concepts learned, supply and demand, understand why oil prices rise during wars or why properties in newly developed areas appreciate. Economic cycles, identify recession periods, opportunities to buy undervalued assets or expansions, ideal moments to take profits. Everyday applications, debt negotiation, use scaling strategies, paying higher installments when interest rates are high to pay off loans. Consumer decisions, analyze seasonal trends, for example, cheaper electronics in January, like a trader studies charts. Transformational example, Tony, a history teacher, learned about stop loss while trading crypto. He applied the concept when refinancing his apartment. He set a maximum acceptable interest rate for 0.5% annually and rejected higher offers, saving $18,000 over 5 years. Conclusion, more than a skill, a mindset. Mastering the basics of trading isn't just about executing trades. It's about cultivating a culture of financial ownership. In a world where state pensions are uncertain and crises are cyclical, this knowledge is insurance against dependency on others. Next steps. 1. Study for free. Use platforms like Investopedia or Coursera for introductory courses. 2. Practice safely. Use demo accounts for 3-6 months before investing real capital. 3. Connect the dots. Relate each trading concept to a personal financial decision. For example, leverage versus payroll-deducted loans. Trading is not an end, but a means, a language to decode the world of money and, in doing so, write your own story in it. Section 4. To grow through challenge. Trading financial assets is like climbing a mountain. It demands preparation, persistence, and resilience. The difficulty is not a detour, it's the very essence of the journey. It's in this rugged terrain of uncertainty that the most valuable lessons are hidden, capable of transforming not only investment portfolios, but also the way we face obstacles in all areas of life. This topic explores why trading, in all its complexity, is one of the most powerful tools for personal development when approached with a strategic mindset. 1. Why is trading hard? The anatomy of the challenge. The 4 pillars of complexity. 1. Intrinsic uncertainty. Markets are chaotic systems, influenced by unpredictable variables, geopolitics, algorithms, crowd psychology. 2. Battle against primal instincts, fear of losing, and greed to win more, are evolutionary remnants that sabotage rational decisions. 3. Mathematical risk management. Requires precise calculation of position sizing, leverage, and asset correlation. 4. Constant adaptation. Strategies that worked in 2020 may fail in 2024 due to regulatory or technological changes. Revealing insight. A 2022 study from the University of California found that 72% of beginner traders underestimate the time needed to master market psychology, On average, 2.3 years of consistent practice. 2. The alchemy of mistakes, turning losses into wisdom. Common mistakes and their hidden lessons. Example 1. Doubling down on a losing trade, adding to a bad position to recover losses. Lesson: teaches the value of stop loss, and the humility to admit when a forecast is wrong. Example 2. Ignoring slippage during high volatility. Lesson: highlights the importance of understanding order execution mechanics and hidden costs. Learning methodology. 1. Trade autopsy. Write in detail what went wrong. For example, enter DUR USD without considering the ECB president's speech. 2. Standardize solutions. Create a rule for each mistake. For example, never trade 1 hour before central bank announcements. 3. Scenario simulation. Use backtesting to check if the solution works. Practical case. After losing $800 by entering stocks without analyzing the asset's beta, Mary developed a 5-point risk checklist. Her maximum drawdown dropped by 60% over the next 6 months. 3. Confidence built through micro victories. The neuroscience of success. Brain mechanism. Every successful trade releases dopamine, reinforcing neural circuits linked to discipline and objective analysis. Trap to avoid: confusing confidence, built on process, with arrogance, belief in, mastering the market. Strategies to build healthy confidence. Quantitative trading journal. Record not just results, but metrics like win rate, percent of profitable trades. Risk, reward ratio. For example, 1:3 means risking 1 to gain 3. Emotional consistency. 1-5 scale during each trade. Celebrate process milestones. For example, executed 10 trades in a row while respecting my 2% risk rule, even if outcomes varied. Key phrase: true trading confidence doesn't come from always winning, it comes from knowing exactly why you won or lost. 4. Growth as a byproduct of consistent effort. The 1% better theory. Concept: improve 1% daily in technical analysis. For example, master a new candlestick pattern each week. Emotional management. For example, meditate 5 minutes before trading. Financial education. For example, read 10 pages a day on macroeconomics. Compounding effect. Over 1 year, 365 days, 1% daily improvement results in approximately equal 3,777% growth. Resilience techniques. Extreme scenario visualization. Ask yourself, what will I do if the market drops 10% tomorrow? Post-loss routines. 1. Do 20 minutes of physical exercise to reduce cortisol. 2. Review your trading journal with a clear mind. 3. Talk with a mentor or support group. Conclusion: a reward that transcends money. Trading is a strict but fair teacher. Its most valuable lessons: discipline, adaptability, self-awareness, become life skills. Every chart analyzed, every respected stop-loss, every late night spent studying reports is a brick in building a more resilient version of yourself. To turn challenges into stepping stones. 1. Embrace difficulty. See every loss as a crash course, paid to the market. 2. Document rigorously. Your trading journal is your emotional minefield map. 3. Celebrate the process. The goal isn't to be perfect, but to be 1% better every day. Trading doesn't reveal who you are, it reveals who you choose to be with every decision under pressure. Learning step by step. This episode is the beginning of a journey. There's no pressure to master it all at once. The goal is to understand the why before jumping into the how. Trading is not about perfection, it's about progress. Thanks for watching the first episode of my trading journey, learning step by step. If this content helped you think differently, or gave you something useful, consider liking the video. It really helps the channel grow. And if you're walking a similar path, feel free to share your thoughts in the comments. Remember, this isn't expert advice, it's shared learning, based on real research and lived experience. We're all figuring this out together, one step at a time. See you in the next episode.